Hi, everyone. Welcome to the Timing Research Show for December 21st, 2015. Today we will be talking about the 117th weekly report from Timing Research. So if you haven't had a chance to look at this yet, just go to TimingResearch.com/reports, and you can download this or any past report there. My name is David Kosmeter. I'm the creator of Timing Research, and I have Dave Landry back hosting for me again. So I'm going to go ahead and turn it over to him.
Okay, hey David Cosmeter, and thanks to Timing Research for having me back once again. Sam, let's go to you first. Sam Bourgi of TradingGods.net. Tell us a little bit about your trading, and tell us a little bit about TradingGods.net.
Sure. Thanks, everyone. My name is Sam Bourgi of TradingGods.net. This is my first webinar. I'm very excited to be joining you. TradingGods.net really looks at the broader stock market, focusing, of course, on the VIX Volatility Index, looking at how the market responds to volatility and some of the trading opportunities around VIX and some of the VIX CTNs. And a lot of the trading that I'm doing is really focused on that. I'm also heavily involved in the currency markets as well, looking at the US dollar, the USD CAD, and several others. I have a background in economics and policy, so I definitely have a broad stroke interest in the markets. So everything from the stock market to indices, as well as the forex market. So that's really the work that I've been doing around TradingGods.net, and I'm very excited to be here.
Cool. All right, Andrew. Andrew Keene of AlphaShark.com. You're up next. Tell us a little bit about yourself and tell us a little bit about your trading.
Andrew Keene. I was a floor trader at the Chicago Board Options Exchange for 10 years. I was the largest independent market maker in Apple from 2006 to 2009. And then basically I had to make the transition from floor trader to trading at a computer just like everybody else. The exchanges basically went insolvent a couple years ago. There's still some people down there, but it's pretty much really quiet. It's kind of a ghost town. I know CNBC does their hits from there. They kind of made it very studio-ish. Now I trade upstairs. We have a subscriber base that pays to watch me trade during the day, predominantly equity options. I do trade some futures and forex, but I stick to equity options.
Okay, cool stuff. And your website, AlphaShark.trading?
AlphaShark.com.
Oh, I'm sorry, AlphaShark.com. What are you doing with the website, Andrew?
Okay, so on the website we have a lot of educational information. We do a lot of blog posts. We do try to do at least a blog post and a video every single day. And like I said, our main product is a live trading room. We have close to 500 subscribers that come in there that are all independent. I'm not a registered investment advisor. I can't give recommendations or advice. But I sit there and I talk about my trading, talk about my trading style, what I'm positioning. I'm currently long the market. I think the market's going to go higher into year end. And we also do a lot of webinars. We've written 13 courses. I've written 5 books in the last 4 years. So we've always got a lot of things going on, a lot of different products, a lot of educational information.
Okay, cool. Yeah, you broke up a little bit there, so I didn't catch all of that. It sounds like you're pretty busy. All right, Jim. Jim Kenney, he's a veteran of the show at OptionProfessor.com. Easy for me to say. I think I would be able to say that by now. Jim, for those of us who don't know you, tell us a little bit about yourself, your trading at OptionProfessor.com.
Well, what I do is I provide the content over there for the OptionProfessor.com for their educational DVDs, and basically the idea is to educate people on all the uses and the risks of the different strategies out there, which are innumerable, obviously. And some people have been in options a long time. They obviously can glean some different ideas from the DVDs, and those who are intermediate or shall we say beginners certainly get a whole lot out of it. And basically that's what I try to do, get people understanding all the different strategies, so when they see a circumstance they have a menu of choices of strategies, and make sure they understand the use of the risk of each one of them.
Yeah, as I say, each time you're on, a lot of moving parts with the options, so it's good that you're doing that educational stuff. I'm Dave Landry. For those of you who don't know me, from DaveLandry.com. I believe you can only predict the short term when it comes to markets, but you can stick with positions. Easy for me to say. Longer term, if the trend begins to develop, and I call it my hybrid approach to money and position management. I'm slotted as a swing trader, but again, I'll stick with a position as long as it moves in my favor. I have a 21-page report on my website. If you go to DaveLandry.com and you go to products, it's the first thing in the store. It's a free under free reports. And I also have some reports on some of my other patterns there. Everything I do is fully disclosed. Nothing is proprietary, and I believe in keeping things simple. In fact, I actually trademarked the phrase "trading simplified," as you'll see when you go to my website. Okay, Sam, let's go back to you for question number 2, which is based on any technical fundamental indicators you want to use, would you predict that the S&P 500 will move higher or lower from today's open to Friday's close, which is going to be the 24th. I guess we're closed on Friday, so I guess it'll be Thursday's close. And based on that prediction, rate your confidence by estimating the probability you have correctly predicted next week's, or this week's, I should say, market's move. Sam, can you hear me? Can anyone hear me?
I can hear you.
Okay.
Sounds like you might be having some technical difficulties or something.
Okay. Who can hear me out there?
I can hear you.
All right. Let's go to Andrew then. All right. Did you hear the question?
Just repeat it one more time so I get all the dynamics about it.
Okay. Is the market going to go up or down between now and Friday? And rate your confidence on that that you have correctly estimated it. What percentage would you give yourself as far as how correct you are? It's the same question that's in the report.
I would say about 65% chance we go higher. We usually have this Christmas Santa Claus rally. I got positioned pretty long on Friday. I actually would have liked to see the futures. The futures opened up on yesterday at 5 p.m. Central. I would actually like to see them to sell off initially and then get a rally. Today we rallied a lot and actually sold off intraday. But I think as long as we hold Friday's low, 65% chance we go higher.
65. All right. All right. Who else can hear me?
I can hear you, Jim.
All right, Jim. Same bet question, same bet everything. Up or down, and what percent are you correct?
Well, again, this is just a guess as it is with everybody on such a short-term basis, but my opinion and guess on this thing is that it will drift higher. The 2000 area, 1990 area has been tested a bunch of times, and on a short-term basis, some of the technical indicators would be a little bit on the oversold side. And so as they did try to rally it, as he was saying, and then come back down, it's his trying to hold this 2000 area. So if it does do that and the VIX can stay well behaved here, under 20, maybe even under 16 would be great. You could see a bit of a a bit of a rally going into the end of the week. The longer-term moving averages on the 50 and the 200-day on the S&Ps up in the 2060 area. They actually seem like they're converging at that area. So it'll be interesting to see if they even try to bring it up that high in the next week or two. But right now it does look like it is trying to stabilize and have a little bit of a rally by the end of the week.
Okay, percent correct?
Oh, I'd say 60 or better, 60% or better.
All right. All right, let's see if Sam can hear us yet. Sam, can you hear us again? We have Sam muted. I guess he was getting a little feedback. Oh, there you are. Sam, can you hear us?
Yeah, I can. I think I had some technical difficulties there. Sorry about that.
Yeah, no worries. Did you hear the question?
I didn't. Please repeat.
Okay. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 will move higher or lower by the end of this week? And once you answer that, rate your confidence to that answer by estimating the probability you have correctly predicted this week's market move.
Mm-hmm. So yeah, I definitely do believe that the S&P will move higher by the end of the week. I think that the Santa Claus rally will come a little bit early this year. We saw a pretty sharp sell-up on Friday, so I'm expecting a pretty significant upward movement in the next couple of days. In terms of the indicators, I mean, on the fundamental front, which is really what I've been mostly focusing on, there's not a lot happening. There's a durable goods report coming on Wednesday, which I think could have some movement in the market. I think that the manufacturing sector in the U.S. is definitely under pressure, and there is some concern that, at least based on some of the analysis that I've been reading, that some people are maybe wondering whether or not the Fed raised rates at the appropriate time. Certainly, the manufacturing data may suggest that we are experiencing some more weakness. So that's definitely one indicator that I will be looking at. But ultimately, I do believe that we're going to be trending a little bit higher this week. And again, I'll be paying close attention to the VIX because there's definitely an inverse relationship between the VIX and the S&P 500. So the VIX should decline this week, probably below the historical average of around 20. And insofar as that trend holds, I expect the S&P to close a little bit higher this week, probably around 60 or 70% sure. I can't say with absolute certainty. One thing I will be monitoring, however, is the commodity prices, oil prices.
Well, save some for the next question.
Sure. Okay.
The next question we're going to ask you why you think that. So, but yeah, good, good stuff. Good answer so far. Very plausible. I think we're going to head lower, and you guys talked about the Santa Claus rally, and I can't help myself, but in today's column, I don't think Santa Claus is coming, and I actually put this little disappointed child in here in my column today. Let me see if I can get the. Well, we're gonna. I'm jumping ahead too, but in the next segment, I'll show you the actual chart. But I just wanted to show you that I don't think Santa Claus is coming, and the reason is, which I'll elaborate on in 1 second, is we do have a weekly sell signal still in effect. And when I say you can only predict the short term when it comes to markets, some people have misconstrued that into that you could always predict the markets. And trust me, you can't do that. If I could do that, you'd never see my fat ass again. But I'm going to stick with down as long as I have the sell signal in place and not try to chase my own tail up and around each week. And I think I'll be right over time, not right every time, as I've been saying quite a bit. And I'm going to give myself 65% on that. Okay. Let's go back to you, Sam. Now's the time to elaborate on everything, and let me actually read the question to make it make more sense. What developing events, technical or fundamental, will you be watching out for during this week that might have a positive or negative impact on the U.S. and other markets?
Sounds good. So I guess I'll just jump back into my point on oil prices.
Perfect.
Right now we're looking at Brent crude is around 11-year lows. We saw last week quite a significant sell-off coming as a result of declining oil prices. When you look at the S&P's energy component, it's down over 22% on the year. So even, I mean, for me, just the extent of the oil price collapse over the past few weeks has taken me a bit by surprise. But when you look at, OPEC and U.S. Commercial stockpiles, it makes sense. So I'll definitely be looking at the price of oil and seeing how that's going to be impacting volatility and investor sentiment. Other than that, as I mentioned, I'll be monitoring the VIX and also the U.S. dollar. I mean, the response of the dollar to the Fed rate hike was perhaps not as expected. It's still hovering below the 100 mark on the U.S. dollar index. So with the exception of the USD CAD, which is at 11-year highs, the dollar it's not quite as, it hasn't peaked yet as far as I'm concerned. So it's definitely one area that I'm going to be looking at.
Okay, cool. Are you bullish or bearish on the dollar? Just curious.
I am. I'm quite bullish on the dollar, and for me, I take my cues also from Goldman Sachs, which recently tipped the dollar as 2016 is the year for the dollar. All the indicators seem to show that the dollar will strengthen next year.
Okay. And, did you cut out when you said bullish or bearish?
Yeah, I am bullish on the dollar. Yeah, I am bullish on the dollar.
Okay, fantastic. Cool. Andrew, let's go to you next. What developing events, technical and fundamental, will you be watching out for this week that might have a positive or negative impact on the Ps and other U.S. markets?
One thing I always look at is oil. So oil is down again today. We did see some institutional buyers of XOP, which is an energy ETF, call buyers in January. So maybe someone placing a bet that the low is in. I actually got long oil today via the XOP calls. So it's an oil and gas exploration ETF. So I got long that. Oil's a big one. The VIX hovering around 20. Now it's under 20. It's something I keep an eye on. Also the TLT, which is 10-year interest rates. As the TLT goes higher, interest rates go lower. So those are the three main components I'll be looking at. Price action, price momentum. As I said, we opened up a lot this morning. We sold off, and now we're finding some buyers in the market. If we can hold Friday's low or that 2,000 level, I think we should be good to the upside. But oil is something, if we get a reverse on oil, I think the market will rip to the upside.
Cool. All right, let's go to you, Jim. What developing events, technical and fundamental, are you watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, again, the VIX and the oil prices clearly are going to be a couple of things to keep an eye on if you're a short-term viewer of this market. The oil trying to make another low here today, so this $35 area would be very interesting to see if that can hold up for a little bit. If it does, and if it ever did have a rally, of course, that would be very positive, I think, for the markets, because there's a lot of nervousness out there with the high-yield markets, which are a lot of them are linked to oil, and the essential crash that's going on there. And if you can take some of that worry out, you certainly must have a reasonable amount of people short or out of the market. And of course, if a volume comes in of short covering and spec on the buy side, the market makers will probably bring that offer up pretty fast. So again, it'll come down to liquidity right now, as it has been recently, and if they can instigate some kind of a short covering buying spree, the market makers who'd be on the other side of the trade will probably raise that offer pretty good. Again, if you take out 34 and you take out 20 on the VIX and start at any rate going towards that 26 spike of last week, then all bets are off, and we could go back into the soup, which is kind of what Dave was kind of thinking might happen.
Okay. As far as I'm concerned, I think we still have this, or I know we still have the sell signal in effect. A couple things I want to point out. If you go back to 2009, this market has pretty much just gone up for a long, long time. Take a look at like a monthly chart. But one thing you notice, and I can't actually draw it in this package, but you can see that we sort of kind of rolled over a slowed momentum over the last year or so. In fact, we're actually negative on a year right now, and I'm still bearish from the market because of that. I don't want to chase my own tail, but we did have a weekly sell signal. That's why I don't want to change my mind just yet. And that triggered right here. And so far, that really hasn't worked out. And in today's column, I wrote, whipsaws are frustrating, but bear markets are devastating. And that's quoting from my good friend Greg Morris. And I wrote all about that in today's column, so check it out if you have a chance. But we do have this signal still effect, and so far it hasn't worked out so good. But now we're beginning to get a bit of a double top in here. And notice that this right here is the 50-week simple moving average. And it's beginning to flatten out. And one thing that I often point out, if you just pay attention to these bow tie moving averages, which is a 10-day simple, a 20-day exponential, a 30-day exponential, when they come together and begin to spread out, you can have some major moves afterwards, especially if this happens after coming off of all-time highs. Last couple times this happened, the market dropped nearly 50%, actually over 50% in 2008, and 40-something% or more in 2000. And right now we do have, this is the first signal we've seen in years off of all-time highs. So I think it pays to pay attention. And quoting Greg again, we take all, back when he was running about $5 billion or so, he once said, we treat all signals as if it'll be the big one. And I fully agree with that. So I think sometimes, as I often say, he who fights and runs away lives to fight another day. So it doesn't mean that I won't buy any stocks right now. We're long one. We're looking to buy another one. But we're being very, very selective, and we're actually putting on a few shorts lately in the market. So I think we're still in trouble. Now, what would negate that signal? If we went off to make new highs, or went on to make new highs, I should say, then all bets are off, and then we, it's one of those frustrating whipsaws, and we just live with it. And again, he who fights and runs away lives to fight another day, as I've said 1,000 times. So I'm a little concerned about the market at this juncture, based on the recent sell signals that we've seen. Sam, let's go back to you for the next question, or what's called a question of the week. What procedures do you use to monitor and evaluate your trading results and progress over time?
Yeah, so I'm looking at some of these answers. I mean, I definitely use a little bit of everything. Definitely, the volatility index is giving me a lot of insights on the performance of the broader stock market. That's something that I definitely watch very closely. In terms of the my currency trading, I tend to keep it very simple. I look at things like support and resistance levels, the MACD and the RSI. I definitely tend to write everything down and just to simply monitor it on a week-to-week basis, and essentially looking at the number of positive trades versus total trades. So a little bit of everything, but definitely focusing more and more on the volatility index as I venture more into stocks and into the indices.
Okay. All right, Andrew, same question.
Yeah, I look at my predominant technical indicator is called the Ichimoku Cloud, otherwise known as Ichimoku Kinken-Hoi. It's a Japanese technical indicator, and it's been really popular lately. If I look at the S&P on the daily chart, we are actually neutral territory, which means not bullish, not bearish, but neutral. We would turn bearish if we broke about 1980 to the downside, and I think there's steam down to about 1870. But like I said, we did not break Friday's low of 1991. Today is an inside day, which means a lower high and a higher low. So it's not bullish or bearish. I think price action towards the end of the day will be most important to see how we settle. So we had a huge sell-off on Thursday and Friday. Today we come in, we're up, and now we're back down a little bit. How does the end of the day price action look? If we close on the lows, we'll probably get more follow-through. If we close on the highs, then I think we continue higher.
Okay. Were you answering the prior question, or were you answering the question of the week? No, number 4. Question number 4 was, what procedures do you use to monitor and evaluate your trading results and progress over time?
So the thing I look at is Ichimoku Kinken-Hoi, and another thing that I look at is, basically statistics. So the statistic is that we rally into the end of the year, and a lot of the stocks that make new lows from Friday, which was triple witching, maybe quadruple witching, actually outperformed the market from December 18th to February 18th. So on Friday, I put on a lot of option positions in oversold stocks. It's called tax loss selling, and those continue to outperform, I think, from now until February 18th. So I was actually looking to get long stocks on Friday that were hitting at new 52-week lows.
Okay. Jim, let's go to you on the question of the week. What procedures do you use to monitor and evaluate your trading results and progress over time?
Yeah, again, the option professor doesn't get involved in trade recommendations on specifics because they're doing education, and that's what I'm providing. But if I'm outside looking in at any type of trading situation, a percentage of winning to losing trades is a good way of keeping track of different people that are doing trading. And then, of course, peak to valley drawdowns. How much volatility you're getting with this type of an approach. And then, of course, the monthly, quarterly, and annual results is a good way to gauge what an advisor or somebody is doing. So percentage of winning trades to losing trades, obviously, because you don't want to have, an imbalance there. And then, of course, peak to valley drawdowns, you don't want to try to keep the equity from looking like a big roller coaster if you're looking outside. And then, of course, the quarterly and monthly and year-end results would be three ways of taking a look at how things are going.
Okay. It's kind of interesting. The question was kind of taken 2 ways. Some people saw it as what methods are you using, and other people seem to see it as how are you tracking your results. And so I'm kind of seeing it as the latter. And based on that, I think it's very difficult to look at someone's statistics and broadcast that forward, because I've seen a lot of things that have an extremely high percent correct amount of winning, 80, 90% or whatever, and then I've seen that fail miserably over time. So I think it's difficult to gauge that. I think that if you understand the methodology and you understand what's the worst thing that could happen to you, and as long as you're making small bets, and I hate to use the word bet, but bet on each position for lack of a better word, and you're keeping those drawdowns intact, you're being selective, meaning that you're not going to trade as a trend follower when the market's going mostly sideways. I think you just kind of gauge yourself against yourself. I think benchmarks aren't I don't think that's a good idea to compare yourself against a benchmark. But since everybody does that, I'm proud to say that the most, not most, but for the year, we are in the black, even if you followed everything mechanically, and S&P 500 is negative for the year. But when you're trading a trend-following methodology, you never really know the next big trend is going to come along, so you just kind of have to chip away at it. So I think it's very difficult to look at statistics unless somebody's doing something mechanical, and then I would pick that apart even further when it comes to trading. So track your results, obviously. If you're getting a lot of losing trades, then you're doing one or two things wrong. You're either not being selective enough or your stops are too tight. So make sure you go in and study volatility to make sure your stops are outside the normal volatility. For my methodology, outside of normal volatility is I'm looking at a short-term volatility of a market, and I'm trying to make sure I stay out of that short-term volatility, so hopefully I capture the short-term move And then I transition myself into a longer-term position trade after I take a partial profit, and then hopefully ride out the trade for a long, long time. I know I just used the word hope, and you're not supposed to use that in this business, but I think on any given trade you can be wrong. And again, as far as evaluating performance, after every trade you need to do post-mortem and ask yourself, did you do the right thing or not? Not whether or not the trade worked or not. If you did the right thing and you followed your system, then keep following your system. But if you didn't follow your system, whether you were successful or not, I think you need to question that. So don't worry about the benchmark so much. Don't worry about what anyone else is doing. Worry about yourself and use yourself as your own personal benchmark and just try to get better and better at your trading. Okay, we had a technical glitch or two. So did I get to, Sam, Andrew, Jim, you all three answered that, correct?
Mm-hmm. Yes.
Yes.
Okay, fantastic. Okay, Sam, let's go back to you. Any closing thoughts or anything else you want to tell us about? It could be about anything, the market yourself, your website, tradinggods.net, or what else? Yeah, I think that's it. Or the markets itself, obviously.
So I think we could begin with tradinggods.net. We have developed a VIX trader, and it's really a one-of-a-kind tool that allows traders to look over our shoulder and see what our positions are with respect to the VXX and several other ETNs for educational purposes only. So Trading Gods is definitely expanding, and over the next few months we hope to roll out some more webinars as well as some more daily articles. In terms of the broader market, it doesn't look too good for 2016. I've been doing a lot of research and a lot of work on what we can expect to see next year, and with the exception of the dollar and a few other key sectors in terms of the stock markets, it's definitely not looking very good. I know Goldman Sachs recently announced that their projections for 2016 are very low in terms of total returns in the market. I believe 3%, including dividends. So definitely a challenging market to navigate, and I think that the collapsing oil prices really complicate that. So I think that it's important for traders to be mindful of the broader economic environment, and I think that for the first time in a while, I mean, I'm relatively new to this. I've been involved for 4 or 5 years, but fundamental indicators are definitely playing a bigger role in the market, and I think that you can expect to see a lot more of that next year as policies diverge between the U.S. and the other economies, especially in Europe.
Okay. All right, Andrew. Andrew Keene of AlphaShark.com. Anything else you want to tell us about the market or AlphaShark.com? Floor is yours.
Thanks. No, I mean, one thing I always do is I try to just tell everybody that we are really, really heavily into education. We've written 13 different courses that are 8 hours long over the course of the last 4 years. Like I said, we have 5 books out, 4 new books coming out via ebook next year. Anybody can always personally get a hold of me at andrew@alphashark.com. I'm not a registered investment advisor. I only trade on my own trading account, but I have a pretty significant chunk of money in there throughout the course of the day. So I just want to help the industry educate and teach as much as possible. And anybody can feel free to get a hold of me if they have any questions. My email is basically 24/7. Andrew@alphashark.com.
Cool. All right, Jim. You know the routine. Anything else you want to tell us, or anything?
Yeah, a couple of things. Just, obviously opinions here and just a broad view because we tend to talk about weekly stuff, which, is obviously a very close guessing game. Going into 2016, I think there's 5 words that you're going to want to keep an eye on. The first one is stimulus. It's going on in China, it's going on in Europe, and it'll be interesting to see what, if any, effect that really has on those 2 big economies over there. Second one is rate hikes. The U.S. has already started a campaign. Is that campaign short-lived, or is it going to be extensive? And is that going to collapse the yield differential and really start hurting even more these leverage bond funds, which obviously have made out because borrowing nearby and buying further out and making that spread. You can see the high yield funds are really in big trouble across the board, and that one in New York obviously shut down, so the investors couldn't even get their stuff out of there.
Yeah, that'll work until it don't.
Yeah. Well, I mean, there's a lot of dough in there because they smoked everybody out of money market, and people like yield, and so they thought they probably were in something a little safer as far as those yields are than they are. So that's another one. Devaluation. China did one last year, was very disruptive to the markets. Not off the table that they might do another devaluation to try to get that economy going again. Dividend cuts and suspensions, like we saw in the oil sector and some of these high yields. people bought into these high-yielding oil companies and stuff. And if they hear the word cut, it's kind of like if you went into a restaurant and you run in there because you were hungry and they told you the chef was off that day. Everyone would probably leave that restaurant pretty fast. So they got into those dividend-paying stocks and dividend-paying interest income for a reason. If that reason's gone, so will the people. Now, the last thing here is the transport and the broad-based indexes. The transports look like garbage. They're down over 20% from their November 2014 highs, which is by definition into the bear market territory. And as David mentioned and I'd mentioned, the broader-based indexes like the Russell and the New York, certainly are very, very sluggish and kind of fading. So, you got to keep an eye on all these things. But if you start making out 21.35 on the high, and if you start, getting situations turning around, you can always see the other side of the coin flip over. But right now, as we speak, there's certainly a reasonable amount of clouds up there in the sky. And the last thing is liquidity for next year. If these algorithm guys come in here because you break 1980, you won't even be able to spell Dave Landry before the thing drops, a very fast amount. And I can spell Dave.
Or Jim Kenney.
Or Jim Kenney. These short names are not going to help you if it starts getting into a dripping type thing. So anyway, I think 2016 could be pretty exciting, volatility-wise, both up and down. And of course, they're changing quarterbacks at the end of 2016. And if you look at some of these other changing of the quarterbacks in 2000, 2008, 87, 88, it can get pretty nasty out there. So you got to keep your eyes open. And the liquidity crises that we saw in August and September might not be isolated events as we look forward. Anyway, getting back to Option Professor, which is the reason I'm here, we are talking about 7 DVDs that are available, 5-6 hours of material, balanced presentations on uses and risk, educating people on all the different strategies that are on the DVDs so that you're aware of them, and then you can kind of figure out which strategy might be interesting to you based on your circumstance. But try to take advantage of those DVDs. They definitely are helpful.
Yeah, sounds interesting, Jim. Jim, you said one thing that kind of got me thinking. These people who have done these spreads and all, and the same sort of bunch, or on a similar vein, I should say, everyone who's bought into this market since 2009, they all have this permanent income hypothesis, and now all of a sudden, Fed's looks like they're taking away that punch bowl a little bit, and I think things are going to change. And as you alluded to, we could see volatility return to this market in a big way. So the permanent income hypothesis thing is very important. People think that what they're seeing will always continue, and that's a very dangerous thing. And that's why it may have sounded like I couched a little bit when I talked about returns and measuring returns and such. But the reason I said phrased the answer I did, the way I did was you have to, and as one of you guys said, talked about the drawdowns, I think that's a lot more important than the percent correct or the actual returns, because it doesn't make any difference if you make a lot of money. If you lose it all, then what good did that do you? So I think that as the market begins to deleverage, some of these things could get fairly ugly, as you alluded to. So thanks for triggering that. That's going to be kind of fun to watch.
People are always wondering what would light the match to get liquidity to go really big. And, in 2008, we had nobody wanted to collateralize mortgages because they knew everyone's house was underwater that brought no money down. And then in 2000, it was the nobody has earnings here, and so obviously that was the match. And in 1987, 88, it was the leverage buyouts that were mispriced. And of course, right now, the massive amount of people who bought into dividend-paying stocks and bought into high-yielding bonds. If that game is gone and they're going to either cut, suspend, or reduce that, I mean, there's going to be your match, because imagine a mass exodus out of that trillion and trillion dollar debt. That would be kind of a pretty big liquidity crisis, and so that would be the one to keep an eye on in 2020.
Yeah, I mean, you got me thinking, sooner or later the chicken's going to come home to roost,
It always does.
Yeah, they always do. And along those lines, too, it's like we're in year 6 or 7, depends on how you want to count, of this bull market. And like I once read somewhere, it's like, well, you could bet on a marathon runner, but if he's already ran a few miles and he's smoking a pack of cigarettes a day, maybe he might be getting a little tired. So I think that's got me a little concerned is that we might be getting a little tired of this market. I often say markets go up and markets go down, and people look at me like I pooed my pants, kind of the same way they look at you when you walk into Starbucks and just say, I want a cup of coffee, without, double room for a cream, all this other stuff. Anyway, so I think that we are kind of long in the tooth on this bull market. I'm a trend follower, and some people call me a trend following moron. So I'm just going to follow along. If it continues to roll over, then I'm going to follow it down. If it goes higher, I'm going to go higher. I'm going to stay long and with it, and that's the way I'm going to play it. If you want to follow along, I do have a trading service, which is a paid service. I also have a free version, which is 1 week delayed. I call it Foresight in Hindsight. So you can see what I predicted or suggested about a week ago, and then you can look at it today and see if things are working. So it's sort of a warts and all kind of thing, and an easy way and a cheap way to follow along. In fact, it's free until you're ready to move up to the next level and everything. Again, I have some reports. I have over 1,400 YouTubes. I have plenty of articles and blogs and everything else on my website, so you can stay busy for a long, long time and learn to trade quite cheaply. Any questions? I will and do answer all my own emails at dave@davelandry.com. David Cosmitter, let's turn it back over to you. I guess you go ahead and close up the show. Again, I want to thank you for having me here, and obviously I want to thank our guests for attending today. And I'll let you wrap things up and mention everybody again.
All right, thanks, guys. Just want to remind everyone to go to TimingResearch.com/reports to download this or any past reports there. Most weeks the reports have extra information that we're not, we don't have time to get to in the show, so be sure to check that out. Also, next weekend, go to TimingResearch.com/current survey to download or to fill out the next survey that will be the basis of the next report that's published next Sunday. So I just want to thank all my guests again. Sam, I'm sorry, could you pronounce that for me again, Sam?
Bourgi. Bourgi.
Sam Bourgi of TradingGods.net, Andrew Keene of AlphaShark.com, Jim Kenney of OptionProfessor.com, and of course Dave Landry of DaveLandry.com. Thank you for being on to host again. All right.
Thanks for having me on.
Thanks, everyone. Thank you, David.
Thanks.
Guys.